Hello and welcome to this earnings special coverage on Bloomberg Quint. We are tracking results of Raymond for the first quarter of FY20. The company has posted a revenue growth of nearly 14% on a year-on-year basis. However, they posted a loss largely due to the development charges that it paid for its Thane project. We are joined by Sanjay Bahl, the CFO of the company, to take us through the numbers. Mr. Bahl, thank you so much for speaking to Bloomberg Quint. Let me begin by asking you, the first quarter earnings have been challenging for most of the consumer-facing companies. Can you tell us how did your fabric business and the core business perform during the quarter, and if you could provide us an outlook as to how do you see the sentiments of the consumers moving ahead in terms of spending and growth?
Yeah, so as you mentioned, the situation has been fairly challenging in this quarter. So the macroeconomic situation has changed completely to what we saw last year. Clearly, the sentiment is very subdued. Consumer discretionary spend has slowed down. Liquidity crunch is impacting trade channels, both wholesale and retail trade channels, and the MSME sector is impacted. And this results in lower secondary sales. And this is the headwind that we have seen across our business portfolio. So we have registered a fairly strong revenue growth, but the quality of the growth has resulted in impacting margin, because the lower value products have sold more than the higher value products in this quarter in the suiting business, which has resulted in lower margins in suiting. And some of the impact of the cost escalation in wool that we saw last year spilling over to quarter one. So those have resulted in margin drops as well. Our branded apparel business is the bright spot in this quarter. Good growth across our power brands, also in good growth in our ethnic category expansion that we did last year. Margins have improved as well. We've been maintaining positive EBITDA margins for some time now. This first quarter is a good start to the year as far as margins are concerned. But the other businesses have also been impacted. Our engineering business was impacted due to, again, portfolio mix changes in the businesses. And that has resulted in lower margins and consequently spilling over to the net profit, adverse net profit as well.
And Sanjay, if you can provide some qualitative data for the branded apparel business, there we have seen some growth, but are your store addition plans on track despite the fact that there has been some slowdown?
So on the same store sales growth, it's been flat. So on a like-for-like basis, flat growth. However, because of expansions that we have done across our channels, we have registered a revenue growth there. So we've seen 7% growth in our EBO network. We've seen very aggressive growth in the MBO expansion that we have undertaken. So we've got revenue growth coming in from our MBO channel. The expansion that we have taken now on the retail side, which is the asset-light expansion strategy that we have adopted aggressively, that continues. We added 42 stores in this quarter, largely franchisee stores. And today we are more than 1,450 stores, so over 600 plus towns. So that focus will continue because that's a good cost-effective way to garner revenue growth and make it profitable as well.
Okay, and Sanjay, given the uncertain political environment in Ethiopia, how are the operations shaping up there? What is the capex plan there? And if you could give us an idea on the order book as to how is it panning out for that operation in that region?
So Ethiopia, the good news is that our order books are full. We've got a good response from our customers for sourcing out of Ethiopia. However, the concerning news is that the political tensions are high there in Ethiopia, and there has been an aborted coup attempt recently. Now things are stabilizing, improving, I would say, but certainly the dispatches out of Ethiopia have been impacted, and the capacity utilizations have been lower purely on account of the prevailing tensions there. We do expect things will certainly in the short term improve and stabilize. And the order books are full, as I said, so which means that capacity utilizations will go up.
Okay.
So there are no further capex plans in Ethiopia as of now. It's a wait and watch. We've already built up capacities there, and we would like to maximize capacity utilization there before we look ahead.
Okay. And Sanjay, final question on the real estate business. Because of the development charges, there was a one-time loss in the quarter. But how do you see, cash flows moving from that business? What is the kind of investment outlay that the company will have to give out as its share for, the project at Thane land?
So real estate has got off to a very good start, I would say. Since the launch last year, end of last year, we launched the project. And since then, the sales velocity has been extremely positive. As we speak, we have more than 600 plus booking with registrations over 400. So the collections have been good. Our construction has been ahead of our plan.
Okay.
So this quarter, the business delivered a positive EBITDA of 9 crores in real estate. So, and going forward, there is no further investment that they'll require in terms of cash infusion, because the business is now, construction has started, sales velocity has been high, so it will be on a self-funded basis for the future.
Okay, thank you so much, Mr. Bahl, for taking us through the earnings. So that was the management of Raymond. Thanks for watching and tuning into Bloomberg Quint.